SPACs have taken the investment world by storm in recent years. And in Singapore, SPACs listings on SGX's main board have been possible under a unique framework since September 2021. Unlike an operating company that goes public through a traditional IPO, a SPAC does not have any underlying operating business at the time of the IPO. It is typically formed by an experienced and reputable management team, known as sponsors, who take the SPAC public through an IPO. Sponsors of a SPAC listing on SGX must subscribe to at least 2.5% to 3.5% of the IPO units, depending on the market capitalization of the SPAC, which must be at least 150 million Singapore dollars at the time of listing. As an incentive for sponsors, they will typically be entitled to purchase up to 20% additional founder shares at nominal or no consideration. This is known as sponsor promote. Sponsor securities are subject to a moratorium from the time of the IPO until 6 months after the DSpec in order to align interests of all stakeholders. In some cases, a further 6-month moratorium on 50% of sponsors' shareholdings may apply. A SPAC is listed to raise funds for the sole purpose of acquiring or merging with an existing private operating company. This process of business combination is also known as a DSpec. In Singapore, a DSpec must take place within 24 months from the IPO with an extension of up to 12 months subject to certain conditions. And at least 90% of the IPO proceeds will be put into an escrow account to protect investors' monies. In a SPAC IPO, the investor buys a unit of SPAC, which comprises an ordinary share and a fractional warrant. These warrants will be detachable from the SPAC's ordinary shares and combined as whole warrants to be traded separately later. Each whole warrant will give the investor the option to buy another share at a fixed price after the completion of the DSpec. For a DSpec to happen, 2 things must occur. More than 50% of independent directors of the SPAC must support the business combination, and more than 50% of the SPAC shareholders must vote yes for the business combination. More capital may be needed to complete the business combination. This can come from existing or new investors in a private investment in public equity or PIPE transaction. If the PIPE transaction happens, the holdings of the current SPAC shareholders will be diluted. Another source of dilution is when the warrants are exercised. SGX rules cap dilution due to warrants at a maximum of 50% of the SPAC's post-invitation share capital. Once the DSpec is completed, the SPAC becomes a typical company with an operating business. Investors now have the option to exercise their warrants. Information they may consider before deciding what to do include the existing market price of the SPAC ordinary share, the warrants exercise price, and the exercise period. During the DSpec process, independent shareholders can also exercise their right of redemption, redeem their shares and exit their investment. If at least 50% of the independent directors or at least 50% of the SPAC shareholders vote no for the business combination, the SPAC will then continue to search for a suitable target to acquire. If a business combination does not take place within 24 months from the IPO, the SPAC is liquidated and its remaining assets, including the funds in the escrow account, will be returned to shareholders. This video captures some of the key features of a SPAC. You can find out more by visiting sgx.com/specs or reach out to us at listings@sgx.com.